My name is Leslie Mondesir. I am the Member Solutions Manager here at the bank, joined by Drew Simmons, our Oklahoma Account Regional Manager. We will follow the same format as we have the past webinar series. And then for some housekeeping items, this is being recorded. A copy of the slides will be provided along with a replay link following the webinar today. The Q&A function is there at the bottom of the screen to submit questions as we go, and we will get to those as we go or at the end. And you will receive 1 CPE credit today for your participation in the webinar, along with participation in the polling sessions that we have today. So with that being said, we will get started with our first poll question. We did get some responses. So Drew, I will let you take it over from here.
All right. Thank you, Leslie. Today, we're just going to cover a brief bit on the macro level of the economy. As everyone knows, we've had some disruptions over these last few months due to the government shutdown, a lot of data that has been delayed and missing, and that certainly has put a lot of question marks as to what the Fed is going to do next month. And we will cover kind of the pros and cons of that and what we might see going forward as the government starts to ramp back up and get all operational efficiencies going again. So like I said, where's the data? The data is obviously been delayed due to the government shutdown. As we all know, the Fed uses that data. They are called data dependent based on their economic policy outlooks and decision making. And as a result, we've seen the odds of a Fed rate cut next month slip. GDP, again, that's one of the data sets that we did not get, especially the forward-looking, the estimates. Right now, 4% is what the Atlanta Fed is doing with their GDP Now forecast. The blue chip consensus range is a pretty wide range, everywhere from as low as 1.5% to 3.5%. Again, the inflation data is still pretty much where it was because we haven't had any updates there. This morning, however, we did get an update from the BLS on the labor market. The U3 unemployment rate, the baseline unemployment rate, did inch up to 4.4%, but we did get a surprising upside to the non-farm labor numbers with 119,000 jobs added in September. Of course, that's delayed. We should already have October by now. Hopefully that'll catch up here before too long. HPI index has not been changed, and really just the same theme that we talked about during our Q3 webinar, where home affordability challenges are persisting. We're seeing some news from our regulator, the FHFA, and Director Bill Pulte on some new ideas, whether it's 40-year or 50-year mortgages, other ideas to try to maybe change the dynamic. But the reality is that folks are really still struggling to get into homes. Kind of chart of the day that you see here on the right-hand side of your screen, the median age of home buyers, and that's the key word, home buyers, not home owners, it has ramped up to 59 years of age. So, that's not indicative of a healthy market. We want to see younger families and younger folks contributing to the housing space, but that is still a problem in today's market. So fast forward to rate cuts. We started the month at about a 70% chance of a rate cut for December. That has fallen to 27%. I tread a little bit cautiously here because I want to be able to, understand whether or not this is really because of the data flow delays, or is it because there has been a shift? My gut really tells me it's the former. We are seeing continued weakness. We did get a surprise change in the non-farm data this morning, but the long-term aggregate figures are still pretty low. Where those numbers are coming from by sector, which I'll cover here in a second, is also a little bit concerning insofar as loss of manufacturing jobs and the things that really fuel the economy. And of course, the impact that AI has had, which I'll touch on here in a little bit. But either way, right now, the Fed Funds Futures is asking for about less than a quarter chance of a Fed cut. So we probably not going to see a Fed cut. If that continues into next month, we'll start to see more and more of this data come in as things start to catch up, and hopefully the Fed will have enough to make an executive decision based on the data that they're seeing coming in. But before I go on to any of the other econ slides today, let me just, one, recap what we did on this same poll question this time last year, November of last year. We asked what we thought, what you guys thought would be the terminal low in Fed funds. And about 2/3-ish of you said 3 to 4%. Sure enough, that's about where we are. And so we'll go ahead and open up another poll question asking the same thing. For next year, for 2026, what do you think the terminal low will be in the Fed funds rate? Is it going to start inching higher, 4% or higher? B, 3.5%, C, 3%, D, 2.5%, E, 2%, or maybe lower than 2%, meaning that the economy is maybe struggling more so than we thought, and the Fed really starts to ramp up those Fed cuts. Okay, I'll give a little bit more time here for you guys to put in your answers, and then we'll end the poll. Got most of you have answered. I'll go ahead and end that and share the results. Yeah, so, okay, it's not letting me share it, so I'm just going to let you know what the data is saying. Yeah, 33% of you have said about 3.5%. Another 2/3 of you, 3%. So anywhere from a 3 to 3.5% is what most of you think we'll see with the terminal low in the Fed funds rate. Okay, let's move on here. We were kind of going to start here with GDP. Again, we don't have any of the data they'd normally have by now. The tracking remains at 2.8% due to the government shutdown, because that's the last number we got, the figure that we got back in Q3. But this chart on the right here, the Atlanta Fed puts out their GDP now estimate at 4%. That's a pretty big jump quarter over quarter. And again, as I mentioned earlier, the blue chip consensus, that range there in the blue shaded area, is anywhere from 1.5% to 3.5%. So to me, this says, I don't know. And I think one of the big factors that's driving GDP this year, especially through the first 2 quarters of the year, is that more than half of GDP growth for the first half of 2025 was related to AI investments. Now, you can see this chart here to the right that shows that big pickup there in AI-related investments. Now, AI is all over the news. They're talking, is this an AI bubble? There's a lot of folks that think that this is maybe, pushing a little bit too forward. Companies from all sectors that obviously were not excluded from that in the financial space. We're seeing financial institutions adopt AI technologies left and right, looking at ways to help with efficiencies, but that's a double-edged sword, right? And so I think that's also why we're seeing some of the labor market see some cracks when it comes to manufacturing, when it comes to IT and software development. The actual job numbers themselves are coming down in that space, and it could be argued that that's largely contributed to some of these efficiencies related to AI. But the big question is this sustainable? Is it sustainable to continue to push forward when that much of GDP growth has been represented in the AI space? Okay, just a quick list of the missing data. It's a ton, and it's a ton of the stuff that the Fed looks at on a daily, weekly, monthly, quarterly basis. So a lot of this data was supposed to be released going all the way back through October and into this month, and we still haven't seen much except for non-phone payrolls that came out a little late, but we did get that this morning. That showed an uptick in the unemployment rate, and of course that surprise increase in September of 119,000 jobs added to the domestic economy. Talking about rates have been kind of range bound, right? And largely on the year, you can see this chart shows that the long end of the Treasury curve has come down. Not significantly, but it has come down. And we're seeing right now the United States Treasury rate is anywhere from about 3.8% up to maybe about 4.15%. That's where we stood as of yesterday. And it's kind of up and down, up and down. Clearly the Fed has lowered rates on the lower, the short end of the curve, and T-bills and others have sort of followed suit. And it has created a steepening in the yield curve, as we see here. The dark green line there that you see is the yield curve as of a few days ago, Friday, and the dotted yellow line there is where we were before the Fed started officially, I would say, into their easing cycle, meaning they were more consistently starting to lower rates at the beginning of August. So you can see that steepening there. As financial institutions, we certainly welcome that. We want to see a nice, normal, steep yield curve that helps with our margins. So that's good. The question is that the longer end of the curve really hasn't followed suit with what the Fed is doing. There's a lot more questions and answers on the long-term inflationary picture. Some of inflation has come down. The larger index is certainly down from the peak, but there are some inflationary pressures, and we're seeing that especially on the consumer end when it comes to grocery prices. The consumer squeeze is certainly at play right now. Moving on to housing, right now, housing is kind of following the same trend that we normally see. So what this graph is just showing is just on a given 52-week calendar year, what the trend is in active listings. And that's what the inventory is showing you. The red line is, of course, 2025, the darker red line, 2024, and comparing other vintages going back to 2015. But, inventory in general is down from the peak in 2019, down about 5.6%. But it's up from last year, 16.7%. So that is a good thing. I think a lot of what's been talked about with housing is there's a lot of folks out there with very, very low rates. Obviously, home prices have significantly increased. And so a lot of people are kind of sitting on those very low rates, maybe very low buy-in home price points. And then the new entrants into the space are simply feeling a little bit locked out. Mortgage rates have come down a little bit, but probably not enough to move the needle from an affordability standpoint. We're hoping to see active listings increase, supply increase. But for the first time in United States history, we're actually seeing that existing home prices are higher than new home prices. So that's a very abnormal thing in the market. So there's a lot of things to sort of shake out here. Certainly, lower interest rates might move the needle, might get some refi activity, might get some mobility. But right now, we are down from the inventories of 2019 and significantly up on a year-over-year basis. Negative equity isn't super problematic, but there's certainly some pocket areas. You can see down in Florida, the highest levels of negative equity down in the South Florida region, 11%. We see pockets of that across the country, but not like what we saw following the '08 crisis. So we're not seeing that yet, but home prices are coming down. So we would probably expect, especially new entrants into the housing market in just the last few years, might experience some negative equity, especially those that didn't put maybe the full 20% down and look to more of those low down payment options to certainly help with affordability. But there's a flip side of that coin, and that might be that if you bought into the kind of the peak of the market, very, very high interest rates, those are very highly correlated, and then now we're starting to see home prices come down, you could be faced with some negative equity positions, depending on how much equity you had upon purchase. Again, I'm not going to rehash this, but it's certainly not a good thing that we see that the median age of home buyers is 59 years of age. The home price index relative to median household income is coming down. That's good. We saw that peak in about beginning of 2023, even higher than the affordability issues that we had leading up to the '08 crisis in 2005 and 2006. What happened then? It came screaming down. So we're seeing a very similar trend here recently leading into next year. We might see that come down even more. But the reality is the median household income relative to the average home price in the United States economy is leading more to that affordability issue. And we're quite frankly need to see that ratio come down before we see any new entrants into the space. Okay, as I mentioned this morning, we got 119,000 jobs added to non-farm payrolls. That's great. However, we did see some negative revisions over the last couple of months, and the average really since the spring, since March, has been quite low. Ever since April, if you average all of that together, it's really not a healthy look for the overall labor market. As I mentioned earlier, some of the real key drivers into a nice, healthy economy, manufacturing job losses have entered their 6th month of decline. That's not good. And really, if you go all the way back to the beginning of 2023, we've seen significant declines in manufacturing, and that trend is continuing with no positive end at sight right now. Other sectors, healthcare added 43,000 jobs in September. Food and services added 37,000 jobs. Transportation and warehousing, however, are down 25,000. And the federal employment jobs continued its decline, down 3,000 in September, and a total of 97,000 down since the peak in January. Another problem we're also seeing from the Challenger Gray and Christmas survey that they do. Fortunately, this is not an agency of the United States government, so they continue to put out numbers, and we're seeing those for October. Layoffs have been the highest in that survey, going all the way back to 2003. Naturally, that's not a good thing, and we'll continue to monitor that going forward if those layoffs continue and thus increase the overall unemployment rate. Okay, so from a total U.S. consumer debt standpoint, we're at $18.59 trillion. That continues to increase. We've talked about this in the past webinars, and this year, really going back over the last couple of years, where the average consumer is certainly overly indebted right now. We're seeing, increases in credit card balances and increases in autos and things like that. And so, that can last for years sometimes before you kind of hit that brick wall, the average consumer squeezed to the point where any sort of major event, whether it's a loss of job or losing your home or a medical event or anything, can really, kind of be a tipping point for these folks that are already feeling that pinch. From a delinquency standpoint, we are seeing slight increases based on the information we're seeing from the credit bureaus. This is coming in from Equifax, as published by the New York Fed, their consumer credit panel. So you can see recently we've seen some inching up in the total delinquency status of these folks, whether it's severely delinquent, 120 plus, 90 plus, 60 plus, and 30 plus late. When you look at, the kind of peak in delinquencies following the '08 crisis, really didn't peak until 2010. So you don't really see that. That's kind of what I was alluding to when we talk about these lags that happen in this space where, even when the recession is completely kind of in front of us, so everybody's aware if that is where we're headed, it remains to be seen. But even when you're faced with an official recession, as deemed by the Fed and the VA, you might not see delinquencies happen for another 1-2 years following that. And certainly that's what happened in the '08 crisis. So we are seeing some increases there. When we're talking with our members, our banks and credit unions in our area, we're not seeing a ton of delinquencies, especially all the kind of scares in the commercial space. We're not seeing that much. We are seeing it in autos. We are seeing it in consumer credit, as this chart shows, but we're not seeing it kind of move into that commercial space that so many of our members have exposure to. So we'll continue to watch that closely. Okay, that wraps my slides on the macro level of the economy. Moving into a poll question here. What is your biggest concern? This is a repeat question we always ask. It ebbs and flows from different concerns that we've had over these last couple of years. But right now, what is your biggest concern that you have for the local economy? So we'll go ahead and open up that poll. Is it A, inflation, B, housing affordability, C, unemployment, or D, rising delinquencies? You can see here these last few surveys that we've done. A lot of it's been housing affordability and inflation, followed by delinquencies, sometimes more than others. Just kind of depends on what's going right now. So I'll let those continue to filter in. Looks like we're about there. Okay. Yeah, and we're seeing kind of a mixed bag here. Unemployment doesn't seem to be much of a concern for you guys. We only had about 6% of the room feel that's the concern as of right now. The largest concern seems to be housing affordability. The charts speak for themselves on that. Second to that, rising delinquencies. Certainly that is starting to show up in the data. And then sort of inflation has kind of left the room a bit. Only about 13% of you feel as though that inflation is a major concern going forward. So, certainly inflation has come down, so that's great. But now we're seeing the other side of it, right? The Fed wouldn't be moving rates down. They went from, their dual mandate of, price pressures and a healthy labor sector, moved from the price pressure concern more down to concerns about the labor market. Okay. Thank you for your responses there. And with that, I will go ahead and turn it over to Leslie on member financial trends.
Great. Thank you, Drew. And before I get started rolling again and no one can hear me, can you hear me fine? Can you hear me fine, Drew? Okay, great. Perfect. All right, if we can go to the next slide. What we have started here is, this is a narrative kind of overview that will reflect what we talk about on the following slide. So if you go ahead onto the next one, Drew, we're going to get started with looking at some balance sheet trends, both quarter over quarter and year over year. We'll have banks along the top and credit unions along the bottom, just like previous quarters. And we're going to start on the left side and look at activity that we've seen quarter over quarter. In aggregate, balance sheets expanded from the second to the third quarter for larger members compared to smaller members across the district. And that is both for banks and credit unions, which you can see those are the black bars are for our larger members, and then the blue bars are going to be for our smaller members. However, when you look at balance changes on a median percentage basis, we actually see that smaller members experience stronger loan growth than their larger peers, and we don't see that when we look at the numbers on an aggregate basis. Smaller banks, they did see deposit outflow during the third quarter and an increased reliance on wholesale borrowings. We did see negative deposit growth for the second consecutive quarter on a median basis for all bank members. Again, so like we see with the black bars there for credit unions and banks, in the aggregate we grew, but on a median basis, we actually contracted for the second consecutive quarter. But there were pockets of growth seen in more urban areas, along with some commercial-focused banks and then residential-focused depositories. There were some areas of deposit growth. Moving to the right, on a year-over-year basis, we did see growth for bank members, both on an aggregate and median basis. The percentage of growth was also very similar for both larger and smaller banks when looking at loan and deposit growth specifically. Larger credit union balance sheets have expanded year over year, while smaller credit unions have contracted. You can see there in the bottom right on an aggregate basis. On a median basis, both of them had a positive loan and deposit growth, but were at a slower pace than their bank peers. The decline in borrowings that we see to the far right for both our bank and credit union members, the decline is mostly attributed to BTFP funds that matured over between third quarter of last year and third quarter of this year. And then to a lesser extent, there were some paydowns in both brokered and advances. And when we move to the next slide, we're going to stay with the year-over-year comparison, but on this slide, we're going to focus on the change in loans and deposits on a year-over-year basis and what that trend looks like. On the left side, we have our loan growth year-over-year. So each quarter, we're going to look at the change in balances from the third quarter of this year of last year. And then on the right side, we have the share and deposit growth. And you can see both larger and smaller depositories on the left have generally followed the same trend over the past several quarters, trending down. Loan growth for larger banks and credit unions, they've been trending lower compared to historical trends, while smaller banks, or smaller members, are more in line with historical trends. So you see the peak in growth, and then especially for credit unions on the bottom left, you see that peak in loan growth, and then the subsequent then decline following over the last couple years. And when you look historically back to pre-pandemic, you can see that the rate of that year-over-year change in loan growth is quite a bit lower now than it was pre-pandemic. During the third quarter, loan growth, it did slow quarter over quarter compared to Q2, but it did continue at a moderate pace, possibly reflecting an uncertain economic and fiscal policy outlook. But we do hear from members kind of a mixed bag of outlook for what we expect in terms of loan growth through the end of this year and into next. Credit unions, they saw growth in residential, used car, and commercial lending, while bank lending was mostly concentrated in commercial real estate, followed by an uptick in ag lending during the third quarter. Looking to the right, you can see that share and deposit growth has slowed significantly since compared to pre-COVID activity for all institutions. And these trends, they demonstrate the challenge around retaining and attracting deposits that we hear so often from our members and across the industry. And looking ahead, we do expect that trend to continue based upon just what we hear, the increase in competition, the evolvement of the digitization of banking, and the acceleration of technology use across the industry. Deposit mix, the shift from non-maturity into maturity accounts, we did see a slight increase again in the third quarter, but the deposit mix shift has largely stalled over the past couple quarters as the Fed started to cut rates a year ago, September. Loan deposit ratios have moved higher, will be either nearing or exceeding prior cycle peaks. And as we wrap up loan deposit growth, we're going to ask a poll question on the next slide about what are your loan and deposit growth projections for 2026. We have asked this question a couple times throughout the year, and we have seen a shift in outlook. In the first quarter, we asked this question, and it was a little bit more optimistic on the deposit growth front and has shifted down a little bit in the second quarter, or in May, in our May webinar when we asked this. And then the opposite was true for loan growth. Loan growth expectations tend to increase from the first quarter into May. And so we can spend a few more seconds here. We will see what loan growth projections look like for 2026 compared to where we've been this year. And on the loan growth slide, looks like we're pretty distributed. 3 to 5% looks like nearly half of the room selected, and a third of you expect a stronger loan growth for 2026. And then pretty similar responses, maybe a little bit more pessimistic on the deposit growth projections for 2026, which has been consistent with what how the year has evolved. All right, and moving to the next slide, we will take a look at wholesale funding and liquidity trends. In the third quarter, wholesale funding reliance did increase, while liquidity did move a little bit lower for banks, at both banks and credit unions. And although down from peaking a year or two ago, wholesale funding, historically looking, still remains pretty elevated, filling that funding gap between asset growth and core funding, especially for credit unions and our smaller bank members. And in the third quarter, I would also add probably our ag members. We did see an increase in advanced utilization from our ag members, along with other more rural-based institutions. While other segments of our members, we did see some pay down in borrowing, more so on the line of credit. And we still haven't seen that build on-balance sheet liquidity for banks like we have in the prior cycles. And compared to the first two decades of the century, metrics remain historically low, especially if you look at that blue line, both for banks and for credit unions. We look back, and for banks, we haven't seen that build in liquidity like we have in prior rate cycles yet. I think that reflects both the pressure that we see in liquidity and deposit markets. Credit unions, there on the right, the blue line, we did have seen an increase following past cycle trends, but that's retreated a little bit here in the past couple quarters. Although for banks, we have a median of north of 15%. That's still well above the 10% sort of threshold that we hear regulators prefer our members to stay above. Now we are going to shift to what impact has that had on margins and earnings? And you can see there on the left, we have net interest margin compared in the black line compared to the blue line of cost of deposits, and the trends we've seen going back a couple decades. Business was good for community banks and credit unions during the third quarter across the industry. It continued margin expansion, improvement in ROA, ROE, efficiency ratios, both quarter over quarter and year over year. And then on the right, you can see the change in yields and costs over the past few years versus the change in Fed funds rate. And you can see there at the right that the increase in earning asset yields, which is the blue, was higher than we had in the change in funding costs. Shares in funding costs, you can see on the blue line there to the light blue line on the left, how they stalled over the past few quarters. And I think that's reflective of the Fed pausing for most of this year in terms of rate cuts before resuming rate cuts here in this last September. I think we still have an opportunity that remains for COVID-era loans to reprice higher, which would provide an opportunity kind of continue to expand that earning asset yield for those loans have been a drag on earnings. We have high-cost CD specials that are concentrated in shorter terms, providing the potential to shift some of those maturities into non-maturity accounts. We've seen this with the pricing of various deposit buckets. The cost of CDs, it has declined just a few basis points quarter over quarter, while the cost of savings and money markets accounts, those have actually ticked higher over the past 2 quarters, with the hope that some of those maturing CDs can kind of move into non-maturity accounts. And as the Fed moves rates lower, that cost can be reduced at a quicker pace. Bond yields, they're currently at elevated rates, so there's presents some opportunity to lock in yield, which Drew is going to touch on, as the middle part of the curve has remained elevated. It allows for reinvestment and growth of investments at more favorable rates compared to a lot of bond purchases a few years ago. And if we move on to the next slide, we're going to take a little different look at growth and earnings, specifically net interest income and what drove that improvement. Banks are on the left and credit unions are on the right. We're comparing the change in net interest income from the third quarter of last year to the third quarter of this year, based on 2 key drivers, volume and rate. And we look at the impact of changes in balances versus the change in rates or yields and costs on both sides of the balance sheet. Now keep in mind the rate change from the third quarter of 2024 to the third quarter of 2025 reflects a 100 basis points drop in the Fed funds rate. And this chart helps us quickly see whether growth was driven more by increased business volume or by rate dynamics. For both banks and credit unions, the benefit received rate changes, the benefit that was impacted the change in net interest income was mostly due to rate. And so I'm going to walk through the chart here just real quickly. The black bars for each on the left are going to represent that net interest income from the third quarter, and it's going to walk up to, on the right side of the chart, the current net interest income of third quarter of this year. And you can see the contribution of each asset line item versus liability for both volume, and then on the right half is going to be rate. On the right, for banks, you can see that rate, lower funding costs, was the largest contributor to the increase in net interest income, which is going to be those gray bars, 106, 63, 87, 44. It's going to be when you add those together, the lower deposit costs year over year had a largest contribution to the increase in net interest income. For credit unions, that was the increase in loan yields. largely drove that growth in net interest income. In terms of volume, loan growth was the second highest contributor to improve net interest income, which is going to be that gray bar, the 231 for loans for banks, and then 29 on the right for credit unions. If we were to segment members either by primary business type or size, we may see a different mix of what contributes to growth in earnings. So what we see here in the aggregate for the district may look a little bit different if we segment our members in kind of a few different lenses. And if you're interested in seeing how your bank or credit union, the change in net interest income for your institution versus a set of peers, we can look and help put that together for you also. We're going to slightly move on then to asset quality and capital ratios. Quickly, we'll touch on. We've heard a little more buzz in the industry about credit quality concerns, but bankers within our districts tend to indicate credit trends remain on pretty solid footing. There may be some one-off cases of delinquencies, but all in all, really pretty solid from what we hear from our members. Non-accruals pushed higher quarter over quarter, and not shown here, but restructured loans are also on the rise. They've actually doubled since early 2024, and we crossed the $1 billion mark for restructured loans in the third quarter for banks. For both banks and credit unions, provisions and net charge-offs are both on pace to exceed 2024 levels. On the right side of the screen, we do have capital ratios for banks and credit unions. They continue to improve and remain solid. Although security portfolios remain underwater, those positions are improving and have had a positive impact on capital ratios that do include AOCI. And moving forward, this is not a poll question, but it's a recap of poll questions that we have asked in the past that I thought I would just mention. We have asked the past couple times this year what your top financial concerns were. Drew, you can go to the next slide, along with top challenges. And I've listed the top 3 there that we've heard from members. And during our regional meetings, the fall regional meetings that we hosted in each state, the Baker Group presented on asset liability management. And one of their questions that they asked at each of our states was, in one word, what is your greatest challenge in banking today? And you, in participating in the poll questions, you would enter a word that would describe one of your greatest challenges or concerns for the banking industry. It was a wide variety of responses, and deposits, fraud, liquidity were the 3 highest selected words that members are most concerned with, which aligned with the responses that we have heard from our poll questions that we've asked here in FI Live. And then looking ahead to 2025 and turning into 2026, from the earnings side, there's still some cautious optimism for financial institutions as low rate assets have repriced higher and expectations for funding costs to come down. As we saw on prior slides, deposits and liquidity, they remain top of mind. Interest outlook, complicated, as Drew talked about, with the lack of data with the government shutdown over the past month or so, makes it tough to determine some interest rate policy outlook. Economic outlook, it depends on who you ask. This was also a question that the Baker Group asked at our regional meetings, and you got the responses listed here: confused, teetering, stable, fine. Also got responses of strong and solid, and so it just kind of depends on who you ask. So still remains quite a bit of uncertainty. Regulator scrutiny and attention regarding not just liquidity, but also with credit concerns on the horizon, we hear about from members. And then not listed here, but geopolitical issues, more macro issues, those continue to be present as well. We will move into our liquidity and funding strategies section. And we're going to stay on the liquidity topic for a bit and build on our last FI Live webinar in September, where we had Zach Thompson, a collateral review officer, join us. He discussed what he's seen on the road, some recommendations he had related to pledging collateral. We talked about allocating pledged collateral between day-to-day operations as well as contingency. And so we thought we'd continue that a little bit here in this session as well. And we talk about collateral management, a key element of your liquidity framework, and establishing and defending a meaningful liquidity management framework. It's a common regulatory criticism. Collateral management is paramount. Other key elements related to liquidity management include how do you define liquidity, funding diversification, concentration and policy limits, stress testing, and contingency planning. And by optimizing the amount of pledged collateral that you do have with us here at the bank, it demonstrates the quick and reliable nature of Federal Home Loan Bank funding to your regulators for both day-to-day liquidity needs and allows a quick response to stress scenarios and other liquidity needs. And as we all know, it's much easier to have eligible collateral pledged and the capacity available before a stress event occurs. And then I wanted to share that last bullet point, a quote from the Fed's Statement of Supervisory Operating Principles that was issued a few weeks ago. They specifically said that examiners and other supervisory staff should not discourage and prohibit firms from taking into account liquidity available from the Federal Home Loan Banks in managing their liquidity and performing their internal liquidity stress test. This highlights the importance and reliability nature of the Federal Home Loan Bank system, and then your capacity that you do have with us here at the bank. And then mentioning stress tests, we go to the next slide. This is an example of one of the tools that we have here at the bank that are available to run for our bank and credit union members. This is just a piece of the your liquidity management, but stress analysis is something that all of our members have to pay attention to and put together for their regulators. We do have members that we run this for on a very regular basis that they share with their ALCO and their board and do share with their regulators. We identify 3 potential scenarios, a low, a moderate, and high scenario, which is going to be a low probability, high impact scenario. And this helps document those scenarios and assessment. And we take a look, we make assumptions for inflow and outflow of cash and impact to liquid assets in each of those scenarios. And then look at what you have pledged here at the Federal Home Loan Bank and if there's enough capacity currently to cover a need in one of those scenarios, or if there's additional capacity to pledge and then cover those needs as well. Now, it takes time to pledge additional collateral. So part of the discussion around the liquidity stress analysis is to make this part of your near-term contingency process. The identification of additional collateral available to pledge to the bank, along with other funding sources, allows you to build a sufficient collateral base to utilize in times of stress. Also, take time. The results of this analysis, take time to arrange access to additional funding facilities, both secured and unsecured, if not already established. Also, allocate time to ensure policies allow for meaningful flexibility with all outlets, not just here with us here at the bank. And like I said, review current policies. Flexibility is important. And if you were to start over, what would you do or consider? Just last week, we had a meeting with a member where we ran the stress analysis and looked at the results. And they were in the middle of a process of going through with their board of reevaluating limits and thresholds for borrowing, operating, wholesale funding limits, loan deposit ratios, what their limits were, and if those still made sense. They hadn't been revisited in years. So this is a good starting place to have some of those conversations with your ALCO and your board to see, in a stress scenario, do we have capacity to access here at the bank and our other sources. And we will shift here more to the funding side, and we're going to start that off with a poll question. And our poll question is, where are you concentrating your funding needs? Short term, less than 12 months, medium term, 1 year to 5 years, longer term, greater than 60 years, a blend of terms, or currently not borrowing. I included on this slide some additional recent advance activity that we're seeing. Members are generally staying short in anticipation of further rate cuts by utilizing line of credit, short-term SOFR adjustable rate advances, and short-term fixed rate bullets. We do have mixed activity by members with maturing advances. Some are paying down, and some are renewing. Some are replacing with a different structure, or maybe a portion, maybe more. We hear from members they have the desire to pay down advances as they mature, but given the tough funding environment we stay in, that may not happen. I mentioned earlier we did have elevated advance activity in the third quarter, particularly at smaller institutions, but over the last OLOC balances trend down a bit since peaking mid-year. All right, that poll question closed. My computer froze. Okay, so we have most members are staying short and some are extending where there is opportunity, and then a blend thereof. And with that, Drew, I will turn it over to you.
Thanks, Leslie. Okay, just a few more things before we wrap up today. Just going to kind of talk strategy here for a second. What we're seeing from other members, things that they're doing that kind of anticipating a change in the rate environment, seeing that the Fed is a little bit more concentrating their efforts on creating a little bit more of an easing cycle for the domestic economy, and how would we prepare our balance sheet in anticipation of that. Keep in mind, the first thing that we've seen so far is a steepening of the curve. Of course, again, we welcome that. It helps with our margins. But what happens next? Well, if history is any indication, that will start continue to steepen for a little bit as the Fed continues to lower rates on the short end, as driven by the Fed funds rate and other short-term money market type instruments. But after that, you generally start to see a flattening of the curve, because the longer end of the curve starts to come down as there's a little bit more longer-term projections on the overall growth outlook in the labor market. So right now, you just saw the polls. Most of our folks are staying short. Makes sense, right? You're heading into a falling rate environment. You don't want to extend those liabilities. You want to be stuck with a long-term liability that cannot be efficiently repriced as the curve starts to move lower, rate starts to move lower. So for bullets, it's an opportunity to extend and capture some of those priced-in rate cuts right now. But again, they're staying relatively short. We're also seeing a trend in the SOFR product, and that's kind of just like riding down the curve. Now, you can do that in a number of ways. The SOFR product has is termed out just the same as our bullets are, and they're keeping those short. But what we've seen is that there's a little bit more of an opportunity to put out maybe a 3, a 6, a 9 month, kind of basically inside 1 year on the SOFR product, and look to those maturities as they come due to either go back into SOFR, but you're basically riding the yield curve at that point. You could theoretically do the same thing by keeping money on our overnight line of credit. But it's time consuming. You're kind of keeping an eye on it every day. And some folks have been transitioning from that overnight line of credit to the SOFR product. A puttable is just, largely what I've seen personally, and I know that my counterparts in, Tony in Nebraska, Rusty in Colorado, Jeff in Kansas, have seen some folks do some blending strategies where, they're doing a lot of that. And then they may be also putting in a puttable. So kind of riding both ends there. If you look at our rate sheets on a daily basis, you can see clearly the puttable from a nominal standpoint has the most attractive rates. That put option, just as a reminder, is our option. So naturally, if rates start to tick up again, that put option becomes in the money, and we might exercise that. And you'll have reborrowing from there to look into it. But one of the main strategies that we're seeing, and this isn't just unique to our district, we're seeing it really nationwide. Our counterparts in Des Moines are talking about it. I penned an article with Dylan Wiedemann from the Baker Group talking about this, and it's pretty much just utilizing a leverage strategy. So we've got a lot of these bonds that Leslie had mentioned earlier, kind of similar to a lot of the loans that were funded in that COVID era, that 2020, 2021, where we had ultra low rates. Those are starting to come due. Same thing with a lot of the bonds. And the cash flows are starting to come in from that. So one idea that you can do is take a look at your cash flows over the next 12 months and identify an opportunity to pre-fund those cash flows by utilizing our advances. And that's what this is illustrating here. So it might be attractive for those members with capital and liquidity capacity to be able to hedge that slowing loan activity by increasing your overall spread relationship between advance rates and the bond rates that are available to you by utilizing the cash flows that are coming due over the next 12 months, match those cash flows with terms like a 3-month borrowing and a 6-month borrowing and a 9-month borrowing and maybe a 12-month borrowing that perfectly matches those cash flows that are expected to come due. As they come due, the cash flows come in, you repay the borrowing. And this analysis illustrates that. Taking an example of $10 million, the payments on the borrowing will be about $2.5 million each quarter going to the end of next year. So let's say you entertain this starting next year. The Fed either continues to lower rates, and as those borrowings come due, you can either utilize the cash flows, you can reborrow more. But static, first kind of impression here is, again, take those cash flows that are coming due, utilize that to pay off the borrowings that you term it out to, and the funds would be used to capture some of these higher yielding bond rates that are expected to fall as the Fed continues to do this sort of easing cycle that they have clearly moved into. You do want to avoid some of that strategy bias of not buying or being hesitant. There's been a lot of confusing metrics, if you will, that have come over the last just year where a lot of folks are on the fence. It makes sense. Anytime you're kind of at that cuspy moment when the market starts to turn, that's pretty natural because you just are uncertain as to what the future may hold. Will inflation start to rear its head again? Well, we're already seeing a lot of adjustments to the tariff policies that were certainly inflationary initially, but we're kind of starting to find a little bit more of a happy medium with certain countries that we're renegotiating those deals with. And hopefully, we'll start to see some inflation come down on those more ticky-tack items that affect the average consumer. But either way, the Fed has clearly done a number of rate cuts since August. It remains to be seen next month. We'll see if that's just transitory insofar as just the data delay releases. I would expect that as more data comes out, they'll be more confident in the trajectory of what they want to do with rates. But this strategy in general, it reduces your reinvestment risk as those lower yielding bonds come due. You're able to capture some of that yield that's in the market that's likely to go away and therefore improve margins. So in this example, in a $10 million pre-funding strategy, which this article that we'll be releasing in the next couple of days illustrates this, and we talk about it, results in about $221,000 of net interest income in just that year. And once that year is done, the bonds are locked in the books, and you've got that as an earning asset going forward. Larger institutions might choose to do a bigger block size. Smaller institutions might choose to do a smaller block size. But these are the small, incremental kind of, just kind of base runs. We're trying to get, just get on first, get on second, just trying to move the needle a little bit to prepare for that margin compression that will naturally follow as the yield curve starts to flatten and longer term rates come down. So fixed or floating, you can do this with, floating rate products. If you really think that maybe I could expand that spread relationship even further, if I'm pretty confident that rates are going to continue to move down, the SOFR product probably makes a lot of sense. You could do it with a blended funding strategy, maybe something like a puttable on the longer 12-month type term, and mix that in with some SOFR and bullets and as on the interim and shorter end of the curve. But it's definitely going to give you advanced restructure opportunities within a relatively short window of time. So you can improve earnings with the liability side of the balance sheet. You can improve earnings on the asset side of the balance sheet as well, and therefore lock in those attractive yields that we're still seeing in the market. Okay, this slide, you might have heard from Ryan Gilliland, our Director of Government Relations. He's been talking with the FHFA, and he's recently engaged with the Urban Institute, a national respected nonpartisan think tank. They're based out of DC, and they released a study outlining the critical role of the home loan bank system. So highly encourage you to click the link here that you see on that third bullet point, but just some kind of high level takeaways from this research piece that was released. And it estimates that the system right now delivers about $13 to $21 billion in economic activity. Of course, that helps to reduce bank failure risks and strengthening the financial system overall. And membership has basically come to the conclusion that the membership has reduced bank failure by about 10%, yielding annual savings of $950 million to the insurance system, the deposit insurance system. So, the takeaway here is that the home loan bank system has saved U.S. homeowners about $3.8 billion annually in lower mortgage costs. That includes all the down payment programs that we have, all the things that we do to sustain affordable housing. So that was a really good takeaway. A lot of positives that came out of this report, and this, of course, comes off the heels of the FHFA's report a couple of years ago, looking at the system as a whole. Hey, are we achieving our mission? Are we doing, good to our local communities? We value our members. We're always listening to your needs, what you have coming from the concerns of your customers, concerns from your liquidity issues, regulatory concerns, any of that hand-holding that we like to do. We're certainly here to help. So on the housing front, just a quick update on HCD, Housing and Community Development. We had a massive increase in our funding of the Native American Housing Initiative. We bumped that up from $3.6 million that we had up to $5 million. We awarded 16 projects. You can click on this link, see all those projects. So many of our folks have helped our Native American communities across 4 states. Here in Oklahoma, that's certainly a big concentration of folks that are in need, housing-wise. We've done, youth shelters for homeless folks in the Native American communities, community projects, rehab projects, all these things, up to a $500,000 grant, and many of you have participated in that. We love that this has been a resounding success. We'd love to hear the positive feedback. On AHP, we will announce those awards at the end of this year. So keep an eye on that. That's just our AHP program that also supports housing. A lot of it is multi-family housing and community development. Care requests, for those of you that have engaged with our CARE program, that will close November 30th. And then in early 2026, first quarter of the year, we will announce the HCD programs for next year. Okay, one thing that you've also probably heard about, wires on demand. That was released Wednesday. That was just yesterday in the member portal. This is something that you guys have asked for, so we've went ahead and kind of jumped on that, got all of our software and everything taken care of to make sure that that's available to you on the member portal. So you don't have to call us. We love to hear your voice, but certainly it's a much more efficient process for you. Wires on demand. You can go on there, learn how to do the 2-factor authentication, initiate the wire request, approve it, or cancel it. So if you have any questions whatsoever, please call our wire servicing department. The number is right there, or you can contact your rep, myself for our Oklahoma members, Tony there in Nebraska, Rusty in Colorado, Jeff in Kansas. So please reach out to us if you have any questions there. We'd love to get you all set up and make sure we can help you out as much as we can there. As always, our resource center is available to you If you can just go to our website, that resource center, we've got our financial intelligence page there that has all of our strategies, a lot of the tools that we have available to you that you can inquire about. We can build those out for you. Leslie showed the liquidity stress test tool. We have many, many others, marginal cost of funds tool, our current events for next year. We have AMC coming up. All of those things are available to you. So from a member solutions standpoint, we've got a lot of new products. So when you click on member solutions, you can see that new page that we have coming soon. We'll kind of revamp that, showing you everything that we're doing there. And with that, I will turn it over to Leslie to do a quick overview on our peer analysis.
Sure. Thanks, Drew. As Drew mentioned, the member solutions page on our public site, which you can also access under resources, I believe, on members only. You can go out there and request various tools for us to prepare for you, like the liquidity stress analysis that we discussed earlier. And then here, this one, a return on average equity analysis, a DuPont style analysis where we dissect ROE into key components, and it provides a granular view of profitability by allowing you to compare yourself to your performance to peers. And we allow you to do 2 peer groups, whether those are custom peer groups that you have, along with, we can look at a top quartile performance based off of ROE, asset size, location. We can help you customize peer groups for comparison. This is also going to relate to what we talked about before with the rate volume charts and looking at contributions of volume versus rate to earnings and net interest income. So another option for you, this is popular for our members, that we can update for you on a quarterly basis. And then moving forward, I mentioned earlier also we had our fall regional meetings in August, September, and then October. Here's the agenda that we had: asset liability, regional housing champion award, panel that included Jeff Kuzbel, Phil, our CFO, Ryan Gilliland, our government relations officer, and then Susan Seville, our member engagement and solutions director, or myself, depending upon which state you were in. If you're interested in seeing those presentations, if you were unable to attend, you can click this blue link in the slides that get sent out with the replay link, and that will take you to their presentations. And then next up, our member event will be our annual member conference in Olathe this year, April 15th through 17th, so be on the lookout for registration. We do have, you'll hear from industry experts, and expect a packed agenda that includes the return of a breakout track dedicated to helping new leaders, our emerging leaders track. We also take the feedback that we get from you at our regional meetings, here on the webinars, and then just in our interactions with members on topics that are important to you. So we're working on the agenda now, and I can share that we will have multiple speakers on technology, use of AI, cybersecurity, fraud, along with ALM. So a lot of great information make available to you at our annual member conference. And with that, I will just say thank you for joining us today. Apologize for the technical difficulties at the beginning. We are still working on establishing our 2026 FI Live dates. Those will be determined soon, and we will share those, share the dates with you all as we get those set in our member communications. And I want to wish everyone a happy Thanksgiving and a holiday season. And we will look forward to seeing you back in February of 2026. Thank you.
Thanks, guys. Enjoy it.